The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Live from Studio 2 at Bloomberg headquarters in New York, I'm Scarlett Fu.
And I'm Matt Miller, standing in for Romaine Bostick. We're kicking you off to the closing bell here in the U.S. Let's get a quick check first off at the markets, which had turned down and are now intraday back up. It's been a very volatile session after the meeting at the Oval Office that by now we've all watched, in which the debate got a little bit heated between President Trump, J.D. Vance, and President Zelensky. The S&P 500 now up 0.5%, 58.93, but down for the week, and the worst week that we've seen for stocks since September. The Nasdaq down 0.5%, and the mid caps, as well as the Russell 2000, are down a little bit less than a third. All
right, and as far as our top stories go, let's start with inflation relief, at least for now. The latest read on the Fed's favorite price gauge, reinforcing bets on rate cuts this year, and also keeping the rally in U.S. Treasuries intact. But it does come as consumer spending weakens, especially by those who are not in the top 10% of U.S. households. And that is fueling a growth scare and increasing the risk of economic fragility. Now, speaking of risks, President Trump's meeting with Ukraine's leader, as you mentioned, Matt, quickly falling apart, and with it, perhaps the possibility of a tidy end to Russia's war in Ukraine.
Yeah, absolutely. The president, during his campaign, repeatedly stating that he would end this war within 24 hours of getting to the Oval Office.
I think that was more in spirit rather than by a firm deadline.
He was pretty serious about it, and it has now been 6 weeks and 5 days. I think he's finding that it's a lot more difficult than he thought it would be. Today, we saw President Zelensky, I thought, very odd, leaning over President Trump and essentially blaming him for allowing Russia to reinvade Ukraine to J.D. Vance, who quickly snapped back. And then, of course, things got a little bit out of control.
Yeah, the optics were not good as far as the U.S. was concerned. And you heard and saw President Trump quickly, come back at Zelensky.
And Zelensky has now tweeted and thanked the president, thanked Congress, and said that he hopes they can continue these negotiations for peace. I want to go to Washington right now to speak with a member of the Trump administration. U.S. Treasury Secretary Scott Bessent is standing by, and I'll hand things off to Bloomberg's David Weston, who will do the interview. David?
For our Bloomberg audiences worldwide, I'm David Weston. I'm delighted to welcome now the U.S. Treasury Secretary. He's Mr. Scott Bessent. So, Mr. Secretary, thank you so much for joining us. Ukraine is at the top of everyone's mind right now, and particularly the deal that you were the point person on as you went over to Kyiv to actually first present it. We all watched what happened in the Oval Office. I guess the simple question is, can this deal be saved?
Well, David, the question is which deal, the peace deal or the economic deal? Because clearly it's very difficult to do an economic deal with a leader who doesn't want to do a peace deal. And I will tell you, I was sitting 3 away from President Trump or President Zelensky, and this has to be one of the great diplomatic own goals in history.
If Mr. Zelensky called back right now and said, I'm sorry, I want to put it back together, what would he have to do?
I don't know. Mr. Zelensky and his team were taken out of the Oval, and they kept coming back with that message, and then they left the White House, and it's going to take a lot of repair. And, David, the real tragedy here, maybe things can be repaired with the administration, but I don't know how the American people are going to feel. And more importantly, the economic deal, the meeting today, the real purpose was to show that there was no daylight between the Americans and the Ukrainians. So President Trump's idea was to show that with the economic deals, to show that we're more intertwined, and that would be a symbol to the Ukrainian people, to Russian leadership, and to the American people. And President Zelensky blew that up today. I'm not sure what he was thinking.
As I say, you were the point person, really, for the administration on the economic deal. We all thought on the outside we were very close. In fact, I think many of us thought there'd be a signing today, that we'd have some form of economic deal today. Were we as close as those of us on the outside thought? Were you surprised?
Again, I was shocked that President Zelensky would come into the Oval Office, behave like this, speak to the president, speak to the vice president, but more importantly, disrespect the American people like this. I know he's under a great deal of stress. He and I had a very heated exchange in Kyiv. I think the same thing may have happened between him and Vice President Vance and Secretary Rubio in Munich. And, to come in and behave like this was unacceptable. And look, I mean, what better runway did he have that President of France, Emmanuel Macron, in the Oval on Monday? Yesterday, we had a fantastic meeting with Prime Minister Keir Starmer from the UK, and then President Zelensky today. I mean, you could not have asked for a better arc. And he walked in, and I'm not sure what he was thinking.
Many of us have been in heated negotiations, not at this level, but still heated negotiations where people pound the table, they may walk out the door and things like that, and it's actually part of the negotiation. Is that what we saw today, or was this a more fundamental rupture?
David, you don't do a negotiation with the President of the United States in public like this. That we were scheduled to have lunch afterwards, and that perhaps he could have brought up some of the points. Instead, he chose to let things go into a downward spiral on worldwide television. And again, I keep coming back to the disrespect of the American people. It was one thing for President Zelensky and I had an extended, heated negotiation in Kyiv. But we were going to get this economic agreement done. But when you bring it out to the public like this, we'll see if there's any coming back.
If there is further negotiation, do you expect to remain the point person on the economic deal?
I expect to be the point person on the economic deal, but ultimately it's going to be up to President Trump whether he thinks that he can continue negotiating with President Zelensky.
What is in it for Ukraine, the economic deal? Why is it in their best interest to sign this deal?
The economic deal is a fantastic deal because if you think the U.S. is willing to co-join its economic interest with Ukraine, and like I said, a very, very strong symbol, potential for very high returns for Ukrainian people. And again, it was meant to be a very strong symbol to Russian leadership that the U.S. and Ukrainian people are more co-joined. And we have economic interest on the ground. Economic security becomes military security. The economy of Ukraine coming out of this, I thought our deal would have really been an accelerant to Ukrainian growth. I mean, you look at Poland next door, and since the Iron Curtain came down, when it came down, Poland and Ukraine had roughly the same size economies. Now Poland, before the war started, Poland's was 4 times larger. So Ukraine has a lot of potential. We'd hope to help unlock it. We'll see whether a deal can be done.
Would it be beneficial to Ukraine, though? I understand why it might benefit the United States. But you've heard some people like Larry Summers said to me, this is sort of like Versailles, except that the Germans were the aggressors in World War I. These are the victims. Why should they give up natural resources? What's wrong with that argument?
Well, look, I think Professor Summers should comment on things where he has all the facts. And Versailles was debt. This is equity. We get nothing if the Ukrainian people don't get anything. It's win-win. So there is no debt component here. Many of the European loans, or much of the European aid, has come in the form of debt. Thus far, U.S. has put in grants, and this is not debt. If it were debt, the Ukrainian bonds would not have been going up on the deal. So I think Mr. Summers, Professor Summers, should maybe call me and ask for the details before commenting. Maybe it's a nice media line that it's Versailles, but it's just not the truth.
You also have some other responsibilities besides trying to get an economic deal in Ukraine. Let's talk a little bit of the economy. And specifically, you and I have talked before, you have as a goal, as I recall, getting the deficit down to 3% of GDP in the United States. Saying it's going to take a little time to do it, not right away. What role does revenue from tariffs play in your spreadsheet when you look at getting to that 3% number?
Good. David, that's a great question, because that over the coming weeks, months, as we put the budget together, your viewers are going to see lots of different nomenclature. There's CBO scoring, and CBO scoring will likely not include any tariff income, and so much of the tariff income could be substantial. We will see where the tariffs finally end up. The China tariffs, since they were put on, have brought in substantial revenue. They continue to bring in substantial revenue. President Trump has talked about reciprocal tariffs. If tariffs are his favorite word, I would say reciprocal has gotten to be his second favorite word. And in the reciprocal tariffs, you actually don't know the path of what's going to happen, David, because the idea there is that if Europe has a 12.5% tax on our cars, we could either put a 12.5% tax on theirs, or the tariffs could get dropped altogether. So it's going to be very path dependent, but I would expect that with the 10-year scoring that the CBO likes to use, that there could be substantial tariff income over the next 10 years.
When we look at tariffs, there's a lot of different things being talked about, proposed, threatened, even imposed. One of them is Mexico, which comes up next week. Is it important to get the revenue from the Mexico tariffs? Because I know Mexico is sort of moving, it appears right now, for example, with respect to tariffs on things coming into Mexico from China. Can they get off the hook on tariffs?
So the tariff negotiation isn't under the purview of Treasury. It's USTR, U.S. Trade Representative, and Commerce. So I'm going to leave that question to them. I do think one very interesting proposal that the Mexican government has made is perhaps matching the U.S. On our China tariffs. I think it would be a nice gesture if the Canadians did it also. So in a way, we could have Fortress North America from the flood of Chinese imports that's coming out of the most unbalanced economy in the history of modern times.
Another one of the goals I think we've talked about is 3% growth. Again, I'm not saying you're going to get there right away, but that's the goal ultimately, as I understand it. We have some people now starting to say the indications about a coming recession are going up, including Torsten Slok from Apollo, somebody you know, who came out with a note today saying the probabilities of a recession are going up. Is that what your numbers show you?
David, it's early. I do think that we're seeing kind of the hangover from this excess spending in the Biden 4 years. And what we are going to do now is something that I've talked about several times on your show in the past. We're going to reprivatize the economy. And as we bring down government spending, and get the private sector moving again, that may not be a perfect one-to-one ratio, but I'm sure it's going to happen. President Trump said the other day, someone said, well, when does it become your economy? He said, probably 6 or 12 months out. I think I would agree with that.
We also are seeing some numbers, some sentiment numbers. The consumer sentiment indicates that inflation expectations are rising. Now, that's not necessarily the hard numbers. We're not necessarily seeing it in consumer spending yet. Sooner or later, this has to come into sync. What do you think the American people get wrong as they anticipate more inflation?
Well, I think, look, I'm not going to question the American people's current conditions because we're still living through this Bidenflation. I think that over the next 6 and 12 months, that as we deregulate, drill more American energy and establish our energy program and then make the 2017 Tax Cuts and Job Act permanent, get some certainty, that I think that we could very quickly go back to the Federal Reserve target of 2.0%.
We've also talked about the 10-year, and you've indicated that the yield on the 10-year is an important indicator for you. That's on your dashboard as you assess how well the economic plan is doing. It's gone down to 4.2 from 4.4 since the election, but it's still at 4.2. Do you have a sense of, and I'm not asking for a specific number, but a range that would indicate this economic policy is working?
Well, David, again, it's going to depend on how quickly the inflation drops, what the growth level is. But I would say that I believe interest rates have come down more than 20 basis points or 20-something since the election. And the other thing that's important is mortgage rates have come down, and the spread on mortgages versus treasuries have come down since November, which I think is indicative of some of the things that we're going to do in financial deregulation. So the housing market is stuck now, but I would expect that the housing market sometime in the next few weeks is going to unfreeze. The other thing on the economy here is I having been in the investment business for 35 years, I'm used to anomalies, and we've got a lot of anomalies going here, whether it was the tragic fires out in California, the cold weather in the Northeast. So we're not really looking at kind of comparable data. Also, there's been a big jump in import data, or the level of imports in the economic data, and some of that may be manufacturers or consumers pre-stocking in anticipation of anticipated tariffs.
Again, if you're looking at the yield on the 10-year, I'm curious about what levers you have as Secretary of Treasury to pull or push to affect that. You've mentioned financial regulation and deregulation. What about the tax bill? Where are we on that? What will that do to the yield on the 10-year, and what are the likelihood of it getting passed?
Look, I think we're pass-fail on the tax bill in terms of we're going to pass. We are going to get it passed. We started this week. I lead something that's called the Big Six. So it's the Treasury Secretary, Kevin Hassett, Chair of the National Economic Council, Senators Leader Thune, Ranking Member or the Chair of the Finance Committee, Senator Crapo, Speaker Johnson, and Jason Smith, who chairs the House Committee. So the six of us have started working on the bills. They're going into reconciliation. So I'm quite optimistic on the progress they're making. The House had a very close vote, but Speaker Johnson got it over the line. And again, I think that certainty will help establish the parameters. And then again, it's the deregulatory agenda and the getting energy prices down. So I think we could go back to target pretty quickly. And David, just for a minute, on the other side, what we're not getting any credit for yet, but I'm very optimistic about, is the Department of Government Efficiency. That I think that there are substantial savings to be found here, and there's a lot of low-hanging fruit. I don't know what the number is, but that's a pretty good story. So back to, if we can get growth up through deregulation and permanency in the tax cuts, and then cut spending, because from the first time I was on your show, we talked about this blowout government deficit. So we got to get that down.
Well, let's talk about actually DOGE, and how material that is in your competition 3%. I understand you don't have a specific number, but will it be material? Because it is a very big budget. You have to take a lot of money off of the spending side to really make a material difference in that deficit as a percentage of GDP.
Well, David, I think we can make a pretty big hit here, and the way to think about it is every $300 billion is 1% of GDP. So, is there $300 billion of savings there? Maybe. Is there 150? But everything starts moving us back toward the target, and we're determined to get this down. President Trump at the cabinet meeting talked about balancing the budget. He asked me, how soon can we do that? And we'll see. But I do suspect, in terms of waste, fraud, and abuse, I think most of us think in terms of waste and abuse. I got to tell you that I'm slightly shocked at some of the fraud we're finding, and you're going to be hearing about more of that over the next couple of weeks.
And finally, Mr. Secretary, when you went into this job, you had some specific goals of things you thought you could accomplish, like 3% growth, like getting the deficit down to 3% of GDP. Now that you're inside, and you've actually seen it from the inside, are you optimistic about making those numbers? And What's the biggest risk to that?
Look, it's execution, and we go out every day. We try to, we have our goals. As we said, we've recentered on the 10-year, which is for capital formation, for mortgages. We are working on the budget deal. We are working on substantial deregulation. We're working on the President's policy of energy dominance. And if we get all those done, I think that it'll be easily achievable. But David, actually, I'll take back the word easily. What I am learning in Washington is nothing's easy, but everything's possible.
Okay. Thank you so much, Mr. Secretary. Really great to talk to you. That's the United States Treasury Secretary Scott Bessent. And we'll turn now back to regular Bloomberg programming.
All right, thank you so much. That was David Weston, host of Wall Street Week, speaking with Treasury Secretary Scott Bessent. And he said, everything's difficult in Washington, but nothing's easy. They did talk about the Trump economy and how that'll be a reality in, 6 to 12 months' time. Right now,
nothing is easy, but everything is achievable.
Achievable, a possibility.
Yes. Yeah. I thought it was a fascinating conversation. When you talk about waste, fraud and abuse, though, I really think about Medicare and Medicaid and military spending.
That's the third rail.
Much more than I do about the federal workforce, which represents 4% of the budget, as opposed to military spending, which is 12% of the budget, and then healthcare, which is 24% of the budget. I mean, if you want to really reduce spending, you don't start with, peanuts with tech workers at the Department of Multimedia, right? You've got to go after big, juicy, porky military contracts, but the problem is they're won with lobbyists and good old boys, and of course,
Medicaid is wrapped up in votes.
Is Trump's base for sure.
All right, let's just get you caught up on where we stand with financial markets right now. There's red when it comes to Treasury in terms of the yields coming down. It's green, of course, because Treasury prices rise, but yields come down. You have equities in the excuse me, I'm getting my colors mixed up here because it's been all over the place.
Yeah, there's been a lot of volatility today. So we did have equities coming down shortly after that press conference.
And it's come back up as we head towards the close.
And it's come back, although we're still looking at a drop of about 2% on the week for the S&P 500. The NASDAQ looking at a drop of more like 4% on the week. And in terms of treasuries, I think it's interesting that the 2-year is now below 4%. The 10-year yield is at 4.22, which is more than 50 basis points lower than it had been in January.
At the heights of January, yeah.
President Trump and Secretary Bessent have said they really want to bring down the 10-year. That's what affects mortgage rates. That's what affects auto loans. And they've done at least a good job of that so far. It's come down every single week of President Trump's presidency. All
right, so let's bring in now Vishal Khanduja. He is head of broad markets, fixed income at Morgan Stanley Investment Management. Vishal, good to speak with you. And you heard what Scott Bessent said about how in 6 to 12 months, this will be Trump's economy. But right now, this is Donald Trump's markets. What does the rally in treasuries, the drop in yields, tell you or reflect about Trump's markets right now?
I think the very clear signal from the U.S. Treasury curve move, as well as the overall yields move down, is that the market is significantly worried about growth downside rather than inflation upside. And I think if you just rewind the clock back to December 1st and then fast forward it on and see the yield moves from there, I think the market was very positively oriented from the pro-growth, disinflationary growth, if you will, heading into the inauguration, because that was the sort of the narrative shift at that point. The Fed had already cut 100 basis points, or was very close to in the 3 meetings post the first 50 basis point cut. So you saw a pretty significant sell-off, almost to 470, as you pointed out, and most of that was led by the real yield, again, directed by the policy expectations. And now again, you're seeing the other side of it coming down from 470 to 420, very clearly directed by the real yields and directed by the policy fatigue that you're seeing. So yes, fantastic interview. We buy the direction of where the administration is trying to go, but I think the market is saying that the numbers will get difficult to get there in a reasonable time frame.
The inflation numbers had been difficult, Vishal, with CPI and PPI, but clearly core PCE has come down significantly. We've seen I think 2.6% year over year was the reading this morning, and that's headed towards the Fed's target. You mentioned they cut 100 basis points. They're at 450 now on the upper bound. Do you expect the Fed to be able to get that rate below 4% by the end of the year? Because that's what this market and probably this administration would really like to see.
I think very close to 4%. I think our initial, when we started off the outlook sessions in the back of the 2024 November, December, our base case at that point was still that 10-year will stagger around that 4 to 5%. And the one thing that the market has to get used to is the volatility. I think that was going to be a constant in 2025 that we are going to see. I think at one point, sorry, go ahead, Scarlett.
No, go ahead. Go on.
I think at one point there was a 35% chance of a hike priced in the next 12 to 18 months in the market. We disagreed with that. At this point, I think the odds are very clearly priced in for one, maybe two cuts by the early part of 2026, which is again goes to our base case.
Vishal, very quickly here, what we've seen is that U.S. corporate bonds seem to be replacing treasuries as safe havens, with investment-grade credit seeing less volatile price action than treasuries. Is it easier to make a high-conviction call on corporate credit than it is on treasuries right now?
Yes, I think very clearly, I think the refinanceability issue is not in the corporate America or especially in the investment-grade corporate market. Fundamentals there on the balance sheet side are very, very strong. I think the refinancing issue is going to be on the Treasury side, especially that 20 and 30-year part of the Treasury, as you're going to get, the numbers are going to start to get difficult on the deficit side. And then I think the refinancing of those big chunk of Treasury bills that were issued over the last 18 months, that will be answered by the investors will expect a lot more yield on the 20 and 30-year part of the curve. So, yes.
All right, Vishal Khanduja, head of broad markets fixed income over at Morgan Stanley Investment Management. Thank you so much. Coming up, we're going to take a look at Harley Davidson next in our top calls. This is The Close on Bloomberg. It is just about 3:30 p.m. in New York. This is the countdown to the close. I'm Scarlett Fu.
And I'm Matt Miller, standing in for Romaine Bostick. Very grateful to be here today. Thanks, Romaine, for the chance.
It's a quiet Friday.
Yeah, I know, but no, it's not.
I know.
Quiet.
I'm being.
There's a lot going on. I mean, from really what I was watching at the beginning of the week, yields falling, stocks falling. Mm-hmm. Actually, if you look at U.S. stocks versus the rest of the world, it's the worst start to the market since 1994. So
on a relative basis, although for the week we're looking at 2% declines from the S&P.
That's still
500.
the worst drop since September, right?
It is, but this is a seasonally weak period as well for equities. So let's not forget that.
Yeah, okay.
All right, let's get you to some of our top calls. We'll look at some of the big movers on the back of analyst recommendations. And let's get you started with Walgreens Boots Alliance. Deutsche Bank analyst George Hill cutting his rating to sell after reports that Sycamore Partners would lead to a breakup of the pharmacy chain. Hill says the deal isn't likely to come to fruition given the especially challenged condition of Walgreens' U.S. business. The stock lower by 4.5%.
All right, Scarlett, I'm taking a look at Kava. It's got an upgrade to overweight, which is essentially buy, from Piper Sandler. The analyst says Kava is one of the best ways to invest in the growth of the fast casual restaurant industry, especially since it raised its price less than other eateries have raised their prices in recent years. Those shares up more than 5%.
And Matt, we're going to end things on egg producer Vital Farms. Stifel upgrading the name to buy from hold and setting its price target at $44. The analyst says growth potential has been constrained by capacity issues, but new additions at its farms can better position Vital to meet strong demand for eggs amid the avian flu. Shares currently up by almost 6%. And those are some of our top calls.
Have you tried to buy eggs recently?
No, I have held on and hoarded the eggs that I do have at home right now.
Yeah, at Costco, so I go in there once a week, and the eggs are gone after about 10:30. They said they get their deliveries at 10. They're gone by 10:30. They have a limit.
By the way, it only opens at 10 a.m.
Yeah, so in a half hour they're gone. They have a limit of 3 dozen per customer. But what I've noticed is that the cheaper eggs, the bargain basement eggs, where they treat the chickens horribly, right, are now priced at the same level as the luxury chicken eggs.
I know. The organic eggs, yep.
It makes the decision much easier, less guilt. for me. I want to get from eggs to hog right now. Harley Davidson, I went to take a look at Harley bikes this week. Had a great time down in Austin riding the cruiser line for a couple of days. The shares, though, have had a tough time. Down almost 30% over the past year, leaving some to wonder how the MoCo can rebound in 2025. Joining us for more on this story is Jaime Katz. She's a senior equity analyst over at Morningstar, and Harley is one of the companies under her purview. So, Jaime, what do you think about the problems? I mean, the motorcycle industry in general has had a rough time. If I look at shares of Polaris, which makes Harley rival Indian, they fared even worse. But what can this iconic American brand do to sell more bikes, to move more metal and raise its stock price?
Well, that's a great question. And I think, to get to that, we have to sort of look a little bit further back, right? If you look over the last decade or so, the unit sales or the unit shipments have been completely crushed, right? If you look at 2014, they did 271,000 units that they shipped. We're looking at 146,000 units for 2025. So it's very clear that the total addressable market is changing and evolving. And maybe what has happened is Harley hasn't been as fast maybe to adapt to that. So as touring bikes have become a smaller piece of the total demand for bike market, it has been very hard to stimulate sales. And Harley's made steps to think about what is going to sell? What do we need to do for innovation? But at the end of the day, we're at a really different secular place than we were 10 or 20 years ago. And I think an important component of this is really about what younger and middle-aged people can afford at this time relative to the past. What they need to do is figure out, A, what are people seeking for? That was part of the adventure touring launch, right? And some of the EV, and then what price point are they willing to buy it at? And with interest rates where they are, that's been a pretty big headwind the last year or so. Yeah, big problem. I mean, these are pretty expensive luxury items, really. Even the lowest priced of the big twins, the Street Bob, is $17,000, and they can get up to over $45,000 when you look at the big touring bikes. How scary are tariffs when you look at the situation of Harley Davidson? I mean, obviously they need metal, they need steel and aluminum to build these things. And if they get 25% tariffs, that's going to raise costs for Harley. Also, last time when we put tariffs on Europe, the Europeans struck back at the most American things and tariffed Levi's jeans, Jack Daniels, Tennessee whiskey, and Harley Davidson motorcycles. And they're likely to do that again. Yeah, I guess, the one good thing is there is a fair amount of production domestically, and they do still sell a significant portion of their sales domestically. So that piece is helpful, right? And there is some production capacity abroad where maybe there can be a shift of capacity for things going to Europe, to places like Vietnam or something like that. I think it's been really hard to quantify that for almost all of the companies in our coverage space, because the rhetoric coming out of the administration changes pretty much on a daily basis. So everybody's been afraid to say, yes, it's going to cost us this much. No, it's going to cost something else. But what we do know is that this is not the first time tariffs have been put on. And so I think there were a lot of efforts to mitigate those costs, in 2018 and 2019 when there were tariffs implemented that will maybe help defray the magnitude of them this go around. So these, you're looking at pictures of me riding. That's you? Some of the cruisers. That's me in my leather suit riding, I believe that's a Heritage Classic. How much does that one cost? I think it's about $20,000 for that bike, which sounds very expensive, but in today's market, that's a pretty reasonable price. Mm-hmm. I do want to point out that these motorcycles are famous for being made in America, right? And Americans are not going to buy Harley Davidsons unless they're made in America. A lot of the customer base doesn't even like that they partner up with other companies to produce different brands overseas. So that's not going to change. But Harley could do a lot with its overseas partnerships as it makes bikes, for example, for Indian under the Hero brand. That's all true, but that will require patience from investors. Jaime, I look at
Harley-Davidson's PE ratio, 7 times earnings, 7 times reported earnings, 7.8 times estimated earnings. This stock is incredibly cheap. And, there's been some underperformance. There's a lot of concerns about growth, where it's going to get its growth from. Should this company be publicly traded or should it be taken private?
Well, that's a great question. And I have to say, the multiple doesn't really fit what the business is doing, right? When we look at earnings, they did $3.44 last year. They guided to flat to down modestly for EPS. And in our model, we have them set to earn $3 a share this year. So we are coming in below the guidance. And I think the real problem is how do you stimulate this in this economy? Would it be easier to turn this around without the scrutiny of the public markets? Probably, because if you look at these shares back, I don't know, till the beginning of the, of the century, 2000 or so, there hasn't been a whole lot going on in them. So I think, if there is going to be a step change in how they want to manufacture and they don't want to do it under the quarter-to-quarter surveillance of, the equity analyst community, of course, doing it private is a little bit easier. The question is who is going to purchase them and at what price?
Absolutely. It always comes down to that. Jamie, really appreciate your joining us today. Jaime Katz over at Morningstar talking about Harley-Davidson, which, of course, Matt Miller is near and dear to your heart.
I have just looked at the shares from the beginning of the century.
Yep.
Actually down 20% on an absolute basis. If you look at total return with reinvested dividends, up 26%, which sounds a little bit better, but the S&P in that period is up 540%.
Yeah, no comparison.
Yeah.
All right. Coming up, we're going to catch up with Miki Naftali. He is CEO and chairman of the Naftali Group. We're going to talk about real estate in Florida and Manhattan. This is The Close on Bloomberg. All right, this is Bloomberg Markets, The Close. Welcome to Matt Miller joining me on The Close today.
Thank you very much. Glad to be here.
There's a really interesting story on the Bloomberg. It's the big take, in fact, about Doge and how it's canceling all these different leases that the federal government has as a way to save money. And we talked a little bit earlier on about how they're looking to cut corners or cut costs on small potato items as opposed to the big items like Medicare, Medicaid, or defense spending.
Yeah, absolutely. And there has been a lot in the press about Doge and the costs and chaos that it's causing. I think it was the cover of the Wall Street Journal today, as well as the cover of the New York Times. And of course, it's our big take. So they're definitely stirring things up. The question is, how will this affect the real estate market specifically? I think it's important to note that we do have the tailwind of rates coming down to some extent. That's got to help, right? Because there's a wall of refinancing coming, especially for commercial real estate. And if we get rates to continue on this path, it's going to be a lot easier for landlords to stay.
That is certainly the thinking for a lot of the markets. Yeah. But, in places like Washington, D.C., where the government holds a lot of those contracts, those leases, that's going to be a bigger challenge to address.
Yeah, problem. Let's talk about that right now with Miki Naftali, CEO and chairman of Naftali Group. He joins us here on set. Thank you, first of all, for sticking with us through some ups and downs. The news has been pretty insane today, and we were lucky enough to get an interview with the Treasury Secretary. He has made the point over and over that he and President Trump really want to get the 10-year down. How important is that to your business, to get rates down from what really have been relatively high levels? We haven't seen 5% rates in 20 years.
Right. So the capital market is on the, project development side is quite tight. There are not too many lenders. We are, in a very small group of developers around the country that can get financing in a relatively decent rates.
Where are you getting it?
But in projects in New York, projects in South Florida, but the majority of the kind of small to mid-size developers are struggling. And that's why, by the way, a few years ago, we established our debt business as well, and we are providing debt to other developers and investors because the capital market is so tight. But hopefully, again, if the interest rates will start to come down, I think the capital market will open up and there will be more opportunities.
I'm just wondering where you're finding finance, because I talked to some mid-state real estate players in this city, and a lot of times they're getting financing from overseas. They're not necessarily tapping markets here, and I wonder which markets are more open and which markets are tighter.
No. So for US-based projects, we are getting the financing here. You know, for construction financing, we're getting from JP Morgan, from Deutsche Bank, from OZK, from some other folks that are playing. And again, we are in a very small group of developers that can get financing in a relatively good rate, but the rest of the market is quite tight.
So Scott Bessent told us earlier this hour that the housing market is stuck now, but it will unfreeze in weeks. Where are you seeing demand for the properties that you do build?
Right.
What segment of the market?
Right. So I think we actually, in New York, we have a really, really good sense of the market, because as we speak right now, we have 3 condominium projects in 3 different neighborhoods that we are selling. We opened those 3 projects, the sales office of those 3 projects back in September. And as we speak right now, 50%, we are 50% sold on the Upper West Side, on the Upper East Side, and in Williamsburg.
These are luxury condos, right?
Yeah, mid to luxury, Upper East, Upper West, yes. Williamsburg, very, very nice quality, but the price point is lower than the Upper East Side and the Upper West Side. Then, when we look at South Florida, for example, we have 2 very big projects, one in Miami and one in Fort Lauderdale. And we are selling in Miami, and the market is quite, over there we see buyers from different demographic. For example, in Miami we see a lot of buyers that are coming from Latin America, while in New York most of the buyers are locals. So it's very interesting. We see a lot of interest for a good product. There is not much inventory, again, because the capital market is tight. There are not too many projects that are being built at this point of time.
So the costs of financing, the cost of developing, the labor, all of that has gotten a lot more expensive in recent years.
Yeah.
Is there any way to make money now on building affordable housing?
I think it's almost, if we really want to be honest about it, it's impossible without, you have to have some type of tax benefits, because look, there is not only in real estate, in any type of business, no investor will go and invest in something head on knowing that they will lose money, right? So you need to feel comfortable that you can make a decent profit to cover all the issues that might happen during the investment, right? There is no way with the construction cost, with the insurance cost, with the carrying cost, you can't build affordable. By the way, you cannot build Class A rental building in the US today because it just doesn't make financial sense.
The economics don't work.
It's too expensive. It doesn't work.
I wonder, I think of, obviously, this is not a market you're involved in. You're here in New York, you're in Florida. But when I look at the devastation in Los Angeles and think of the rebuilding there, you need steel to build these things. That's potentially going to be a lot more expensive. You need lumber. A lot of that we get from Canada. And mostly you need labor. And I've seen estimates from the University of Michigan that about 20% of our construction workers are here in this country, undocumented. Of course, it's much more in California and Texas. That's probably way lower than the real figure. What kind of costs do you think we're going to see, in terms of building new houses, new multifamily, new apartments?
Right. So that's a very good question, and I think it's a little bit premature to tell. We bought in the last 2 months over $150 million of trades, construction trades, between New York and South Florida just in 2 months. And I can tell you that at this point of time, there is no change. We don't see any upcharge for maybe additional cost but
that's interesting.
That's a reporting from right now, right? We are on the market. We're buying in those 2 major markets for big projects.
Right.
But it's hard to tell. By the way, it's hard to tell if we're really going to have those tariffs in place, yes or no. So I think there is a lot of unknown. at this point of time, there is no upcharge.
Miki Naftali, really appreciate your joining us and sharing your insight with us. Miki Naftali is CEO and chairman of the Naftali Group. All right, let's get back to our big conversation with the Trump administration that took place earlier this hour. We mentioned it. Scott Bessent, the Treasury Secretary, speaking with our David Weston. And here's an excerpt of what he had to say about tariffs on China.
Very interesting proposal that the Mexican government has made is perhaps matching the U.S. On our China tariffs. I think it would be a nice gesture if the Canadians did it also. So in a way, we could have Fortress North America from the flood of Chinese imports that's coming out of the most unbalanced economy in the history of modern times.
And that was, of course, the U.S. Treasury Secretary Scott Bessent kicking off the show, speaking with David Weston for Wall Street Week. And of course, if you want to hear the whole interview, tune into Wall Street Week later on tonight. But, at issue here is that tariffs and how confusion, uncertainty over these tariffs have really thrown the market, bonds and stocks, into uncharted territory.
Right. Well, we hadn't seen a lot of bond volatility. It had really calmed down as President Trump came into office, but we're starting to see the MOVE index kick up and the volatility is back. I thought it was really interesting what Secretary Bessent told David Weston with regard to tariff offers that the U.S. is getting from Mexico. Of course, the 25% tariffs on Mexico and Canada should go into effect on March 4th. That's Tuesday coming up. But we've seen reports, Eric Martin writing in our Mexico City bureau, that Claudia Sheinbaum is considering putting the same tariffs on China that the U.S. does, potentially putting the same tariffs on Europe that the U.S. does. And Bessent invited Canada to consider the same kind of approach, which I think would be really interesting. If
like the North American countries teaming up against Team China.
Absolutely. Well, and potentially against Europe and the rest of the world as well. Donald Trump obviously wants to get these trade imbalances back in shape, and they are now at the worst level. We have a chart, #BTV 2575. I believe, from this morning. And it shows you the trade deficit is the biggest that it's been in history right now.
Well, and this is something he's keen on addressing. It's become kind of a scorecard in a way, or it certainly was a big scorecard in his first administration. Let's now bring in our next guest. And let's go now to Drew Pettit. He is Director of U.S. Equity Strategy over at Citi. And Drew, I mentioned scorecard for President Trump because in the first term, it really felt like the U.S. trade balance was something he fixated on. Now, there's a lot of talk about how the stock market is his benchmark. It's his traffic light. It'll tell him to go or stop. Do you agree with that?
Not quite sure. Look, it's a little bit hard to disentangle talk from actual policy. And at the end of the day, that's what we're trying to do. But if you're looking at the scorecard in that sense, we're still trading at 24 times. As much as we have this, let's call it a bit of a tariff call. If people want to talk about a Trump put, okay, that's one thing. But we're just a little bit stuck right now because of the confusion, like Matt said in the intro. So look, yeah, scorecard market's stuck, but at the end of the day, it's 24 times. It's a pretty good backdrop for equity valuation right now.
What did we learn this week, Drew, from what NVIDIA told us? The reaction in particular to the decent results. They were good. They just weren't great. They didn't knock anyone's socks off when it came to the outlook, especially for gross margin.
Yeah, look, I think NVIDIA was basically telling you exactly what we know about the rest of the growth side of the market. It's really fully priced. This is not about how you execute backward looking. It's about how that's going to translate into forward numbers. Honestly, we've been talking about three things when it comes to growth in growth stocks. It's revisions, revisions, and revisions. If they don't go up, it's hard for the growth side of the market to really work like it did last year and the year before. And then when it doesn't happen, when we don't get the follow through in revisions, these big names like NVIDIA and the rest of the Mag 7, they just become like any other stock.
You, in your most recent note, you stress that, well, you continue to stress GARP, which I believe is growth at a reasonable price, right? Via your reverse discounted cash flow overlay on the NASDAQ. Explain what that means and where do you find it specifically?
Yeah, it's funny. So a lot of people use a DCF to solve for net present value or the value of the stock today. We just assume the market's right. Let's say price is right, and we have to figure out what the growth rate needs to be for the next 3 years to justify that price. Where we see analyst expectations above that market implied growth rate is what we consider GARP. And you get half the Mag 7, still looks kind of reasonably priced on that type of metric. And we're really stressing that. What that gives us is upside leverage when we do get follow through in out year revisions.
So Mag 7 stocks, I think, down about 7% this week. They've had a rough week. Shocking to me how poorly, especially Tesla, has done, considering the close proximity of the CEO to the White House. I think he actually has an office in the White House, but I guess he's busy doing other stuff.
I thought he was sleeping there.
Do you think Mag 7 stocks are a buy? Do you buy the dip?
Yeah, it's funny. Not wholeheartedly. Look, I'm not jumping into the deep end here. I think how we've framed it, again, what is GARP in the Mag 7 or what is reasonably priced in the Mag 7? Amazon we're comfortable with. We still see tailwinds. Google, I think the pricing there, very fair. Meta, super cycle, there could in its product lineup, that could be further upside. NVIDIA, kind of reasonably priced. Analysts likes it, but we've seen some reductions in estimates. Tesla, Apple, Microsoft. We struggle with those a little bit, honestly. Tesla, don't really care who's in office and who's doing what. If you're buying Tesla today, it's not for the projected cash flows of what the business is today. You have to buy that stock for it to be something else, for it to be full self-driving, for it to be a robotics company. As a car company, what the street has modeled today, you need a lot of upside to justify that price.
Drew, I look at the S&P 500 for 2025. It's up 1.1%. And Matt was wowing us with this stat about how it is actually the worst start to a year for U.S. stocks relative to global stocks since 1994. Is there just a lot more competition now for U.S. stocks, from the rest of the world, that perhaps the obvious America First trade just doesn't work the way it did before for investors outside the U.S. and perhaps increasingly investors inside the U.S. as well?
Yeah, we got to remember that we're up only 1% after being up 20% and then another 20% compounded. So it's, kind of time frame a little bit. Yeah, tactically, look, Europe had just absolutely terrible sentiment, upward revisions there, gave you a lot of leverage. You saw Europe even in US dollar terms up 10%, right?
Right.
But when you look inside the US market, when you get past the Mag 7, there's a lot of growth stocks that are working.
Drew, we got to leave it there.
There's still some exceptionalism there.
Thank you so much. Drew Pettit is Director of U.S. Equity Strategy over at Citi. Let's take you to the closing bell right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
We're about 2 minutes away from the end of the trading day. Scarlett Fu and Matt Miller here. Romaine Bostic and Alex Steele have today off. And of course, we want to bring in our colleagues from radio to take you through a global simulcast, Carol Massar and Tim Stenovic. And of course, in doing so, we bring you the best of Bloomberg Television, Bloomberg Radio, and our YouTube audiences globally to parse through the most crucial moments of the trading day. Carol, it looks like these last, 10 minutes, even hour has been a straight shot up for equities.
Maybe that's what Alex and Romaine are up to. They're at home buying stocks. But I mean, it's really fascinating to see the buying that we've seen into the close here. You've got most names over 400 in the S&P 500. So broad-based buying as we get ready to wrap up not only the day, the week, but also the month. It's been a rough month, though, Tim. You keep reminding me.
It has been a rough month. The S&P 500 down 1.4% on the month. At least as of now, it was a lot uglier this morning. The NASDAQ, though, composite down 4% on the month.
Yeah, it's the rally into the close has been so strong here. We were down 2.5% for the week on the S&P. We were down 4% for the week on the NASDAQ. We were down 7% for the week on the Mag 7 stocks. And they're just pumping up here. You can see NASDAQ gains at 1.7%. The small caps and the mid caps are not doing quite as well. But I look at the Mag 7 index that we have, BM7T index, if you want to type it into your Bloomberg terminal, and I see that it was down at 1.5%. It's now up more than 2.1% for the day.
How much do you think this has to do with end of month positioning? I mean, it is the last trading day of February.
I can't find any other explanation for this.
Window dressing.
Window dressing on the last day of the month. And of course, in these final seconds, we are looking at equities closing near their highs of the session, just coming off the best levels. But you're looking at gains of better than 1%. for the Dow, the S&P, and the NASDAQ. The Dow adding 591 points, the S&P 500 gaining 1.6%, the NASDAQ adding 1.6% as well. And where does that leave us for the week? We're still looking at losses for the S&P and the NASDAQ, but the Dow has now moved into the green, up 1% on the week. The Russell 2000, we should mention, lagging behind a bit here, as it has been for a while, up 1.1%.
Hey, guys, a couple of things. We've got the Bloomberg Mag 7 index up about 2% in today's session, still down more than 4% for the week overall. And back to today in the S&P 500, 438 names ultimately gaining ground on this Friday, 64, Scarlett, to the downside.
All right, let's go over to the IMAP. It's a pretty simple read today. All green, your pesto pizza pie in full bloom here, with all 11 industry groups rising at least 0.8%. Financials, consumer discretionary, and tech are leading the way. And within consumer discretionary, we're talking about auto companies in particular. The laggards, if they are even lagging here, real estate investment trusts, materials, and healthcare.
All right, guys, let's get to some of the individual gainers, if I may. Intel on that list. That one up as much as almost 6% in today's session, but finishing the day with a gain of about 2.8%. TechCrunch out this morning reporting that Intel may delay its Ohio chip factory to 2030 at the earliest. Yeah, I know, exactly.
It's rough for Central Ohioans, Carol.
I know. The Columbus Dispatch actually out with the report
Breaking
today.
That scoop, yeah. We were banking on that, you know?
$28 billion project, semiconductor project in Central Ohio. But again, a delay or slowing, if you will, for the second time this year. So
at least we won the national championship.
Yeah. Hooray, hooray. I should point out the stock's up about 19% year to date. Lots of stuff swirling around Intel, including whether or not TSMC makes an investment. I know Matt's here. All right. Monster Beverage, guys, up more than 5%. This after the company's fourth quarter gross margin topped the average analyst estimate. Net sales also roughly in line Wall Street expectations. So we saw this one really an outperformer among the indices. And then Kava Group. Can't get it right.
I think Kava.
Did you say Kava?
Yeah.
Potato, Kava.
It's like Spanish champagne.
Thank you very much.
Oh, yeah, that's a good way of thinking about it.
Up 5.5% in today's, from somebody who doesn't drink anymore.
Yes, almost 3 years now.
All right, well done. All right, it is up about 5.5% in today's session. Piper Sandler actually turning bullish on this name after yesterday's nearly 9% sell-off. I should point out that we talked to the CFO today. Seems pretty upbeat about the outlook and the expansion. And we'll see. They're continuing
She likes the lamb
invest.
Meatballs and feta too, by the way.
Does like the lamb.
That's what she told us.
I did ask about that. Stock's it was down about 17% year to date, though.
I think we're going to go to decliners now. I want to start with Dell. Matt, it's Dell, right? Dell?
I'm just glad they're all still in the red, Tim. I was worried your decliners might have bounced up.
Oh, I went to make sure before. Don't worry. I went to make sure. 4.7% to the downside for Dell. The company did give a strong outlook for sales of servers optimized for AI, though investors remain concerned about the profitability of these products. Walgreens Boots Alliance shares also fell by 4.7%. This after reports that a take-private deal might not earn shareholders much money. The company has been reportedly exploring a take-private deal with the private equity firm Sycamore Partners. The arrangement might involve splitting the company into 3 different parts, the Financial Times reported on Thursday. Representatives for Walgreens and Sycamore declined to comment. And finally, shares of Duolingo, based in Pittsburgh, down 17%. Shares fell due to its costly AI strategy. It reduced its gross margins by 71.9% in the fourth quarter. Despite the cost, the AI features have been popular with users, and the Max tier now accounts for 5% of subscribers and paid users, rising 51% to over 40 million.
Maybe because of the cost, right? I love it when you see, as a consumer, when you see margins compressed like that, it means you're getting a good deal. They're paying a lot to put those AI features in their product, and I can get it at a relative bargain because they're not making any money.
We're out there buying Blackwell chips now, NVIDIA?
I don't know if those margins have compressed to the same extent.
Okay.
Those are like 70% margins.
Yeah, and also they're like 40 grand per chip. I want to take a look at yields. This has been, I think, the story of the week. The 2-year yield coming in to less than 4%.
Amazing.
The 10-year yield, as you know, we watched Scott Bessent on Surveillance. I think it was it last week or was it Monday? Scott Bessent on Surveillance saying that they're really focused in the Trump administration on getting these 10-year yields down, on getting mortgages cheaper, on making auto loans more affordable. And so far, it looks like they're working. The 10-year yield has come down every single week of the Trump presidency. It's down 55 basis points from its high in January, and we're looking right now at 421.
All right, I agree. I think that was the big story of the week. It was just, a few weeks ago, maybe, perhaps, that people were talking about moving up to 5% on the 10-year, and it's just interesting to see how that has changed dramatically. Guys, one of the stories that caught our attention has to do with Skype, kind of rest in peace, shutting after 14 years and after Microsoft's $8.5 billion purchase.
This is a really big deal. I mean, for people who remember how difficult it was to talk to somebody just a few years ago in another country, Skype was really the only way you could do it. But then you had the rise of other apps like Snapchat, FaceTime. Microsoft, for its part, says the growth of Microsoft Teams is replacing Skype. The company has just, about 36 million users now. Skype.
But it's really hard to make a long distance phone call, an international call to a business. Like if you're going to call a person who's available on Snapchat or on WeChat or on WhatsApp, that's easy. But if you're calling a business and you're calling a landline overseas, you still kind of need Skype. And I tried to get on the other day, and I was told to buy a 1-month subscription, and with that,
So hang on, what business overseas are you trying to make a call to? And have you not just
I can call hotel.
Pick up the phone and dial +44 whatever, right?
But it would have cost like $1 a minute on my mobile phone.
Always saving money, Scarlett.
You didn't use WhatsApp? You didn't do WhatsApp?
No, you can't because they have to be a user of WhatsApp.
Oh, okay.
Yeah, the business isn't a user of WhatsApp.
Skype is like AOL Messenger. I mean, Zoom works flawlessly. Why would you consider anything else? I don't really know.
Well, something to consider. In any case, this weekend, by the way, is the Oscars. I don't know if you guys are going to be watching on Sunday night, but one thing that I always pay attention to is the swag bags that they give out to the presenters and the nominees. This year, they're offering select Oscar nominees a gift bag that's worth over $216,000, including a trip to the Maldives.
Yeah,
how do you fit that in a bag?
Well, it's just one of several trips, right? That's a 4-night stay in the Maldives, $23,000, 5-night stay also.
We just show a picture of naked John Cena? Can we show that?
It was on broadcast television, network television.
I mean, we have trouble getting Victoria's Secret VO approved, and we have naked John Cena? I think it's pretty grotesque to offer
I thought
already.
We were talking about you're saying the bags are grotesque?
Bags. You offer already incredibly wealthy and privileged people $211,000 swag bags? Like, why?
Everyone loves free stuff, and I'm sure they're excited about it.
I don't know, Matt. Sounds like somebody wasn't invited to the Oscars this year.
They end up, what's interesting is they say they a lot of times don't even end up using them because the IRS comes knocking at their door because they're included, I guess, in their income. So
you just leave that trip.
Yeah.
They
don't on the table.
Yeah.
You donate it to someone less fortunate. So
But then they have to pay the taxes on it.
Well, maybe someone overseas. Some of the people that Scarlett's trying to get a hold of on Skype, they could take her trip to Maldives.
Yeah, sure. I'll do that when I go to the Oscars this Sunday.
All right, let's watch the Oscars. All right, guys, what a day, what a week, what a month. That's it for the February trade here on Bloomberg. That's a wrap, too, for our cross-platform radio, TV, YouTube, Bloomberg Originals. We do it all. Have a good and safe weekend, guys. We'll see you again, same time, same place on Monday.
All right, coming up on The Close, we're going to take a look at NVIDIA and the DeepSeek drama that engulfed it. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Matt Miller, standing in for Romaine Bostick. It's pretty exciting, actually, because I watch this show every day.
Yeah, well, you opened the markets, right, at 9:30 a.m., and now you're here to close it, and we close at our highs.
Yeah, I mean, the market is very exciting. I just meant being a part of the show. It's not as good when Romaine's not here, but it's kind of nice to see how the sausage is made. Yeah, the market was insane. I mean, climbing high up into the close. And it looked like
10 minutes.
It was going to be a horrendous week. I was going back and looking at these three indexes for the week, and about an hour before we came on air, so maybe 2:30, the S&P was down 2.5% for the week. The NASDAQ was down 4.5%. And the Mag 7 was down almost 8% for the week. It was the worst performance since November of 2022. But a real recovery. I mean, there's still decent losses, right, for the Mag 7, especially at almost 5%. But what a recovery on the day to bring us down only this low for the week. We saw a continuation of a drop in Treasury yields really across the curve. So if you look at the 2-year, we came in under 4%. Yep. If you look at the 10-year, we're less than 422. I think headed down to 420, which is probably a good sign. And then if you look at
420 now,
Bitcoin really came down, right? It was 94,000 on Sunday night, and then I looked this morning and it was 84. So it dropped 10,000 basically in 5 days. Gold was down to 2,800 and change. And oil, West Texas Intermediate was down under $70. So real repricing of assets this week.
Yeah, a lot of volatility in the price action. Let's go to a couple of individual movers I want to highlight. AES is a utility jumping 12% on the day. It forecasts full-year adjusted EPS that beat the average analyst estimate. And importantly, for a utility, it said it plans to maintain its dividend payments as well. PDD Holdings Pinduoduo, the U.S.-listed Chinese internet stock, along with other Chinese internet stocks declining, halting the rally, at least for now, that we've seen in Chinese stocks on optimism over China's AI capabilities. No, Pinduoduo.
Okay.
We're not going near P. Diddy. Trump's announcement of additional 10% tariffs on Chinese goods really dashing hopes that he was mainly using those levies as a negotiating tactic. So that's not happening, at least for now. Our top story this hour is a roadblock for the first ever private credit ETF. Now, a day after the SPDR SSGA Apollo IG public and private credit ETF, that's a mouthful, made its trading debut, regulators sent a letter requesting more information. The SEC's worries really center on the fund's liquidity, its name, and ability to comply with valuation rules. So what's next for the fund, known by its ticker PRIV? That is coming up later this hour, Matt.
Yeah, I think that's a really fascinating story, especially because you had Apollo saying it will buy an unspecified amount of assets from the State Street ETF if it needs to, and investors need specification.
Yeah, probably that unspecified part was what got the SEC's attention.
All right, it's the end of an era for those of us our age. Microsoft is shutting down Skype in May. I guess it was iconic, an internet calling and video chat service. It's been surpassed in recent years by smartphone apps. Obviously, FaceTime works pretty well. Competitors for business chats like Zoom works pretty flawlessly. In its place, Microsoft is offering users the option to switch to Teams, which so many businesses annoyingly use already for video communication in the workplace. Joining us now for more is Bloomberg opinion columnist Dave Lee. Dave, does it really matter that Skype's gone? Is this like instant messenger no longer being a thing? I mean, did anyone use it?
I think it's going the way of AOL and MSN Messenger and some of these older apps. But, look, I think it's easy to look now and say, well, we've got so many options. You can go on Zoom, you can use, Slack or WhatsApp or FaceTime, like you said. But the degree to which Skype was first shouldn't be forgotten. For many people, Skype was the first product that, worked reliably enough. It wasn't perfect. Certainly it wasn't perfect. And I think with many people, they always think of the sort of dialing tone you got from the Skype as being a sort of quite a huge moment when using the internet, because all of a sudden you were calling internationally, you were reaching, and one of these clever things was that you could do an internet call to a landline, right? So you could be calling relatives on Irish farms, in my case, and and it's all fine. It's not costing you a ton of money. So, look, no one's going to miss Skype. I mean, its active user base was down to around sort of 26 million or so. I was reading, down from 300 million near its peak, but. Even though we won't miss it, it's because they led the way to many of these other applications.
Right.
So I think
it helped people feel comfortable with the idea that they could get rid of their landline and just rely on this new device, this new tool.
Absolutely. And save money. I mean, it's a huge, huge money saver.
I think I kind of got the sense that the end was near when I tried to go on Skype. I was talking about this earlier. And instead of being able to just put $5 in, which is what I wanted to do, they tried to sell me a subscription of a monthly fee. And there was no way I was going to commit to that, because then, you have to remember to cancel it. And I didn't need $30
more as
well.
Calls. I mean, one of the things about moving to Teams, of course, is that Teams does a ton of stuff, So while Skype was revolutionary for a certain era of the internet, it's not what we think of now when we think of the hybrid workforce and a bit of text and an image shared and a video and a shared dashboard, all that kind of stuff. Skype just wasn't the best tool for that.
I mean, and by the way, Teams is annoying to me. It's like a green bubble. You know, we use Zoom here in the first world. Let me ask you about NVIDIA. You had a piece saying like the panic is over post DeepSeek, and the stock price had shot back up, but the earnings were pretty ho-hum. I mean, yes, they beat and raised to some extent, but it wasn't any more than the street was expecting in terms of the outlook. What do you think about?
Well, here's the thing. I wrote that column saying that the stock had recovered. And I had someone a day or so later say, well, you were wrong. The stock's gone back down again. I stand by it. The DeepSeek panic is over. The China panic definitely is, right? Two separate things. DeepSeek was about, does NVIDIA, if DeepSeek is cheaper and can run on less sophisticated hardware, does NVIDIA need to sell so many? Or more to the point, will people buy that from NVIDIA?
It's existential.
Yes, absolutely. And that was where we saw that record-breaking share price drop from NVIDIA back when DeepSeek was driving everyone crazy that week. I've never known anything like it.
DeepSeek turned out to be kind of BS, right? I mean,
I think it was.
It certainly wasn't as cheap as it was made to look.
I think it was an overreaction to some degree. I think the people like Satya Nadella who came out and said, look, what this is actually showing is that this might be a lot cheaper and we might be able to do vastly more things with it than before, and that's likely still going to use NVIDIA chips to train those cutting edge models. That's still the case, and that's the sort of reassurance that I think has come in place. The problem is how does NVIDIA's business look if there's tariffs on the materials to make those chips, and also if it can't sell as many chips to China, which is, despite sanctions at the moment, export controls at the moment, they are still selling a lot of things to China, and that could change.
Dave, I love your work. Always read you on Opinion. Check him out on OPIN Go on the terminal, or look it up on Bloomberg.com. Our opinion columnist, Dave Lee.
All right, coming up, we've got the top three, where we focus in on the top three movers and shakers at the center of the day's big stories. This is The Close. Time now for the top three, where we name drop the people driving some of the day's most talked about stories. And first up is Sergey Brin, the co-founder of Google, says if employees worked harder and were in the office at least every weekday, the company could reach a Gen AI breakthrough. He says 60 hours a week is the sweet spot of productivity.
That's doable. We do that, right?
60 hours? No, yeah. I don't think we do 60
12 hours a day? Okay. I'm watching Jensen Huang, the NVIDIA co-founder and CEO, has come to the rescue of a struggling arts college in San Francisco. Jensen and his wife, Lori, donated $22.5 million through their foundation to the California College of the Arts.
Yeah, the college said it was facing a $20 million deficit in September. So they had to get going on some stuff. And Jensen's foundation's assets are mostly in the form of, guess what?
NVIDIA stock.
Yeah, there you
go.
go.
Which is still pretty hot.
Absolutely.
Very interesting stuff. What do you have on
our top
Khosla?
Three? Our last top three is Vinod Khosla. He is the billionaire tech investor, also a Silicon Valley veteran. He warned that most investments in AI will lose money, especially as more people jump in to fund more startups. And he said, right now we are in the greed cycle of investing because people see the momentum that's been established in the market caps.
That makes sense. That's like people who are investing in fiber optic cable in 1999 and 2000, right?
Yeah.
Cost a lot of money to lay. Turned out to return profits, but only like 7 years later.
Remember PEG, price to estimated growth?
Yeah.
And let's just count how many eyeballs.
Exactly. No one cared about free cash flow. Hey, let's sticking with AI. Let's take a look at the shares of Soundhound AI this past quarter. Those shares up 17% as the voice recognition company rides the high of an earnings beat, and it also raised its full-year outlook. We want to talk about that with the CEO. Keyvan Mohajer joins us right now. He's the CEO of Soundhound AI. And Keyvan, I think it's a fascinating company because of what you expect sort of the future of commerce to look like. Walk us through your outlook.
Thank you for having me. We had a great quarter, great results, and we increased our guidance. We unveiled a new product earlier this year. It's the Soundhound Voice Commerce. We are already powering the voice assistants of a lot of products. We are in cars, we are on TVs, we are on IT devices. We are also powering customer service for a lot of businesses, like restaurants. When you call them or go to drive-through, you talk to our AI and you place the order. What we unveiled is connecting them together. So while you're driving and you're talking to your car for doing a lot of things with the car, you can also discover food options and place your order by talking to your car before getting to the restaurant and going in the line and waiting and then talking to the AI that we also power. And that is going to increase adoption of our voice assistant in cars, our adoption of our AI customer service for restaurants. Ultimately, it brings a lot of value to the user because they can order more, it's safer and more convenient. And we are not going to stop with restaurants. We're going to expand it to other businesses like placing reservations and buying other groceries and so on.
So, Keyvan, how long until this is going to be possible? I am driving a lot, a commuter, I'm testing out cars, and I've also been talking to my Chat GPT. When I ask Chat GPT to do something like, order me the sesame chicken from this restaurant in Scarsdale, it always says I can't do that yet. Or if I want it to look through Auto Trader and pick out a bunch of, 1973 911s for me, it doesn't have the agentic capability yet. How long until we get past that kind of firewall?
Yeah, we really believe in agentic AI. We think, there's some people think it's a buzzword, but some buzzwords don't last a long time, but this one is going to last. We think we are in the world of APIs now, and that's going to transform to the world of agents, where every business and every service is going to have an agent that can perform tasks, and these agents are going to talk to each other. And the experience that you mentioned is going to happen. And Soundhound is actually a leader in that transformation. We are bringing agentic AI in all parts of our business. And the food ordering experience I mentioned is actually one of the first ones.
So, Keyvan, I want to ask you about NVIDIA exiting its stake in your company. In mid-February, we learned that through a 13F filing that NVIDIA exited its stake completely from Soundhound, and your stock, tumbled about 28% on the news. Can you give us any sense of whether you knew this was coming?
We didn't know it was coming before others, but we have a great relationship with NVIDIA. We've worked with them for many years. Our relationship continues to be strong. We had a great joint demo at CES together earlier in January, and we're going to be at the NVIDIA GCC conference next month. We've also attracted a lot of investment from other strategic investors, device makers, chip makers, automakers, cloud providers. And although I can't speak to their investment philosophy, I don't think they are in the business of holding public company shares. They make these investments to create ecosystems and alliances, and those benefits are coming to Soundhound in terms of NVIDIA. Their investments supported us to bring our technology to their software and hardware stack, and that ultimately increases our addressable market, and we continue to innovate together.
How would you characterize your relationship with NVIDIA now?
Is great. Again, we are going to be at the GTC in a month, and just a few weeks ago, we had a joint demo together where we brought our voice AI and conversational AI completely to the edge without cloud connectivity using their GPUs.
All right. Keyvan Mohajer, CEO of Soundhound AI, thank you so much for joining us today. Really appreciate it.
Thank you.
All right, coming up on The Close, we'll continue the conversation on investing with David Dindi. He's co-founder and CEO of Atomic. They have a new partnership with Bluevine. We'll get into all of that and how they're advising investors. This is Bloomberg. The SEC not exactly thrilled with the new private credit ETF. The agency sent a letter to State Street and Apollo about its PRIV ETF, which debuted on the NYSE yesterday. The SEC detailed three major concerns about the fund's name, liquidity, as well as its ability to comply with valuation rules. Joining us now with more on this is Eric Balchunas, senior ETF analyst at Bloomberg Intelligence. Eric, I'm not sure I understand this. Why did the fund launch if the SEC had problems? Did the SEC not stop it ahead of time?
Yeah, basically, your question's a good one. I've talked to some people, and everybody's a little bit scratching their head here. It's a very unusual situation. There's been a couple instances where the SEC will let something out, and then and then basically put warnings out on it, like 2x single stock ETFs. But this one's a little different. It looks like they still had some unfinished business with State Street. Looks like they were upset that State Street didn't file their comments publicly as opposed to confidentially. And it sounds like they were concerned about some of the public comments to State Street that SEC got. They wanted those addressed. But all that said, I'm pretty sure this is just the ship has sailed. The ETF traded today. It did about another 8 million in volume. And the percent premium was only 28 bips. Looks to be doing okay despite that private credit allocation. We'll see what happens, though. Maybe this is the only one that gets off port, and the rest, the ones that try to do this can't do after. I'm not sure. It's interesting, though.
Okay, so there are 3 issues here, and I understand 2 of them, the fund's liquidity and its ability to comply with valuation rules. What about the name? Why is that an issue?
Yeah, because Apollo is not really the issuer. Normally, like when Spider did a ETF with DoubleLine back in the day, it was Spider DoubleLine. Well, DoubleLine managed the fund. Apollo is not managing this fund. They're simply providing bids and asks on the bonds, the credit, and they're the liquidity backstop, which is important. But they feel like maybe the name implies they're managing it. That was their issue with the name. And the idea of a fund holding illiquid securities, you can only do up to 15% traditionally. But this filing looked like it solved the ability to go beyond that. So currently, it has about 21% in private credit. So this is why it's such a big deal, is that it figured out a way to go beyond that 15% threshold. Well, this opens up a whole new world of possibilities for ETFs.
Yeah, solved is a pretty strong word, right? Because they did it in a pretty half-assed way. It's undefined. I'm looking at a note from Morningstar. They say Apollo's liquidity facility is subject to a daily limit, and this daily limit remains undefined. That sounds problematic. It's possible that the fund could have to meet way more redemptions in a day than the limit. That could force State Street to sell more liquid public securities first, potentially leaving the ETF with more in illiquid private credit instruments as a percentage of assets and increasing the risk of a liquidity crunch. That does not sound good, Eric.
Yeah, no doubt. And those are all real concerns. I think a couple things here, though, is that one, Spider, State Street, is a reputable manager. This is an active fund. The managers are going to do a good job of getting good deals for those private credit, in my opinion. And you're trusting them if you buy the ETF. You're thinking they're on the lookout for you. So Apollo will have to be held check by them. The other thing is, in a crisis situation, and we've seen this before in many ETFs, typically 100% of the fund doesn't leave. Usually 10, 15% of investors leave. So yeah, maybe if there is even some illiquidity crunch in the ETF. The good thing about ETFs is they still trade, right? We've had ETFs that hold Russian securities that were frozen, and they still trade on. Some ETFs have the whole underlying stop for months, like Egypt one time, and that just trades on. A mutual fund is where you have, I think, more problems with a fire sale because then you have to halt redemptions. The good thing about an ETF, at least it will rock on and carry on with trading. It just may have a wider premium discount and look like a hybrid of a closed-end fund for a little while.
Is this the, I don't do a show on ETFs, but I often watch a show on ETFs. Is this like the Bud Light of private credit exposure? Bud Light has 4.2% alcohol by volume. Budweiser has 5%. So that's where you get really drunk. This just gives you a little bit of a buzz. Is that the right way to think about it?
Yeah, I guess if you want to take that metaphor further, though, this is the only beverage they're serving to the investors. So it's Bud Light or bust if you're retail. That's the thing. But yeah, it's only a baby step towards having a private equity or credit exposure. But it's a big baby step. And I think the problem is private assets people want them. Mm-hmm. You could debate if they should, but those are hard to get for retail. ETFs are the bridge between that world and retail. And that's why this is a big deal, even if it is a Bud Light kind of offering for now.
Yeah, ETFs, the solution to so many different things, as you well know. Eric Balchunas of Bloomberg Intelligence. And of course, you can catch Eric, Katie Greifeld, and me on Monday at noon on Bloomberg ETF IQ. This is the show that Matt
That's the show I was referencing.
Anchor. Okay.
Well, I filled in for a little bit. I mean, you started the show, right? I thought you started it, actually. Now Eric reminds us that he did an ETF show with Adam Johnson and Trish Regan, which has to be at least 10 years ago.
No. Yeah. Eric has been like the voice on ETFs for Bloomberg forever.
I think he's been the voice on ETFs for the industry, really.
All right, let's talk about another partnership that we're watching here, and that is the one between fintechs like Bluevine and Atomic. The two companies are teaming up to offer high-yield cash management solutions that let small businesses share in the upside of higher interest rates. For more on this, we're joined by David Dindi, co-founder and CEO of Atomic. David, it's good to speak with you. Before we get to the high-yield cash management solution that I just mentioned, I just want to get your take on the accessibility of private credit investing, like the ETF that we were just discussing. Is there a demand from small businesses that you're trying to serve for these harder to access assets?
I think it's actually the other way around. We service a number of different companies, and actually one partnership that we have, aside from Bluevine, is also with Yield Street, where we're allowing retail investors to be able to participate in private credit funds. We don't provide, private credit opportunities for businesses, but we do provide that to retail investors across various of our partnerships as well.
And is this something that an ETF makes more accessible? Is this something that is greatly in demand, or are the companies involved here kind of rushing it?
I'd say an ETF would make it more accessible. It'd make it easier to trade without having to enter into subscription and redemption agreements with the fund providers, no doubt about that. But we do think, and it would also make it more accessible in allowing people to invest in smaller amounts as opposed to having to invest with minimums. But to date, our focus has really been on providing direct access to the private credit funds, specifically focused on funds that are registered with the SEC and that are available to not just accredited investors, but a broader set of investors in that regard.
David, as you mentioned, you have other partnerships that provide investors access to smaller pieces of investments, like I remember you partnered up with NerdWallet to allow investors to buy, I guess, fractional bonds, right? I thought it was fascinating, as not everybody has the financial capability to lay out $10,000 at a time. So how is that working right now? Are investors taking advantage of that?
That product has taken off. A lot of people are going on the NerdWallet website to get access to T-bills and to be able to buy T-bills in amounts of a cent. And so it means for the first time you can actually have a savings-like account that has easy liquidity, but you get the benefits of holding T-bills, such as the ability to be exempt from state and local taxes. Since launching that product, we've just seen, significant growth within the NerdWallet ecosystem. We've also expanded that product to also include other robo-advisory capabilities within that ecosystem as well.
I also want to ask about, you have a partnership with Uphold, and you work with other digital asset exchanges. We saw some real movement in Bitcoin leading up to, obviously, President Trump's presidency, and now in the last 5 days, we've seen it drop $10,000. How do you think this crypto thing shakes out? I mean, Bitcoin is the OG and seems to still be, the main investment, but obviously stablecoins are a very important part of this world as well.
The way we see it is that we're not shying away from engaging with the digital asset ecosystem, because if you look at the data, 42% of Gen Z investors hold some form of cryptocurrency. That's 4 times more than the percentage of Gen Z investors that hold retirement accounts. And so it's here to stay. And in the run-up post the election, we actually saw a number of our partners open thousands of accounts per day, and we're still seeing that momentum persist today. Now, naturally, digital assets and Bitcoin, there's a lot of volatility inherent in it, and perhaps the slump will shake out some of the speculators, but some of the veteran investors will definitely continue to stay and be exposed to that space as well.
So when it comes to demand for those digital assets, are people still looking to go in through the actual token itself, get the underlying, or are they taking up the ETF industry on these different offers for leveraged products, which at least put them in a little bit of a remove in that they're not holding the actual token, but they're holding many cases, derivatives of things tied to the digital coin?
I'd separate it into 2 types of investors. Investors that already have a brokerage account and want to very easily expand their exposure to Bitcoin or Ethereum, where there are ETFs available for them to get access to that. And so we do see that class of investors, and we do have partners that are offering access to digital assets in that regard. But then there are also other investors that not only want to hold Bitcoin and Ethereum, but also want to hold other coins that are out there in the market. And so for those types of investors, it makes a lot of sense to go through some of these platforms like Uphold and others to be able to get exposure to those underlying tokens as well. And so I'd say it really breaks down to the different types of investors and what type of exposure they're looking to get in that regard.
All right, David, really appreciate your joining us today. David Dindi is co-founder and CEO of Atomic. And Matt, we were talking about this earlier. Bitcoin, 6th straight day of losses. It doesn't take a break from trading, right? Every day is a trading day for Bitcoin.
Exactly.
But this is something where even as we've seen stocks recover today and Treasuries on a bit of a tear, they've been on a pretty good run here. Crypto has not gotten the lift that the other assets have. No, but it got a massive lift up into this, right? Let's keep in mind that Bitcoin is still trading for $84,000. Yeah.
About 10 years ago, I did this thing where I lived on Bitcoin alone for 2 weeks.
That.
Remember?
Yeah.
And I bought,
how much was it worth at the time?
I bought my first one for $800, and I bought my second one for $600. Unfortunately, I spent those 2 Bitcoin. Otherwise, I'd be sitting on $170,000 right now.
And you probably wouldn't be sitting next to me.
Well, I would still be here. It's such an honor, really.
We like you being here, too.
But I miss Romaine.
All right, by the way, we should recap what happened in markets today because we referenced it kind of obliquely, but it was a rally into the close, actually for the last 2 hours, pretty much a straight line up, as investors looked past the confusion over what happened at midday when President Trump and President Zelensky met up in the White House and had, kind of a war of words. Yeah, we saw a big drop after that. Equities turned lower, I guess, right around 12:30, 1 o'clock. We dropped down to a loss of about 0.5% on the day, and then we rose up to close 1.6% in the positive. So right back up against 6,000 on the S&P 500 at 59.54. The 10-year yield, though, now down at 4.20. Yeah. And remember, it was just January 14th that we were looking at 4.80 in the danger zone. This feels a lot more relaxed. No one's talking about 5%, 5.5%, 6%, at least not right now. Yeah, no, we're hearing people talk about much lower levels, and that would be a relief. I think this is a housing market that absolutely needs it. You saw new home sales yesterday plummet. This is Bloomberg. Pickles are known for their sour taste, but one company is turning that sourness into sweet, sweet success. Grillo's Pickles started in 2008 out of a wooden cart in downtown Boston. It's now grown to be available in 28,000 stores nationwide. Joining us for more on this story is Adam Kaufman, CEO of Grillo's Pickles. And Adam, I'm guessing this is a family recipe that you've had sitting around the house for a century. How did you, I guess, bootstrap this company into such a huge nationwide success?
So first off, thanks for having us, having myself here. And I have to say, it's actually not my recipe. It is a family recipe. It was started by Travis Grillo and his family. I joined the company about 7 years ago. So it's been an exciting run. But as you said, in 2008, we started with a pickle cart on Boston Common. A few years later, someone from Whole Foods was in line, saw it, and the rest is kind of history. From 2016, we were at a national footprint, and the brands just continue to grow. People, really get the understanding of what a clean, fresh pickle tastes like. So, has it been a growing market? I've noticed pickles a lot more in sort of pop culture, from the 5-year engagement Pickle Shop in Ann Arbor to Seth Rogen's An American Pickle movie. I think it was on Netflix. Are they picking up in popularity? So it's interesting. So pickles are having a moment, but that moment's been going on for a while now. I think it's been happening probably for the last 6 or 7 years, pretty much when I joined the company. I don't think it has anything to do with me. I'm just a lucky guy, I guess. But it's, we've been doing a lot of work around bringing people into the refrigerated section for pickles. So getting a cold product versus a warm product. The refrigerated category itself has been growing dramatically over the last few years. really with the work we've been doing to bring people out of the warm shelf stable aisle and into the refrigerated section, shopping that perimeter of the store where the better for you products typically are.
So, Adam, I got to ask you about your primary cost, which has to be cucumbers, because they're the main ingredient for pickles. And, they depend on a couple of things. Sometimes they're imported from places like Mexico. Then you have to worry about weather as well. You can track a lot of things on the Bloomberg, but I can't find an index that tracks cucumber prices. Can you give us a sense of what the price history has looked like over the last couple of years?
Yeah, it's actually been pretty steady for the most part. We follow the typical crop, so we go all the way from Mexico, which clearly it's a topic these days, through Florida, up the coast, up through the Midwest, and then back down again. So on an average cost basis, it's been pretty similar. We haven't taken any price increases in the marketplace. We're a premium product already, so we try to make sure that the consumer is getting the best value for their money, which is what we've been doing for the last 6-7 years.
And how are you getting around or thinking about getting around the tariffs that will be imposed on Mexico?
Yeah, that's a great question. So we do split a lot of our products. So there's somewhere in the mid 40s is 40% of our business does come from Mexico. But there's offsets that we can do coming from Florida and other markets. So we're keeping a close eye on it. It's every day is a new day for that. As you guys see that. So we're just trying to manage through that right now.
We're a couple weeks past Valentine's Day, but I was reading through the notes and saw that you had a pickle bouquet for Valentine's Day, and it sold out. So what other kinds of strange, unexpected products are you selling that are pickle related?
So, it's interesting when I talk about having a product that's having a moment. Having different collaborations is really important for us. We don't have a huge marketing budget. So we want to have collaborations where people are talking about it. And the Pickle Bouquet has been doing it for years for us. I think over the last 2 or 3 years, you've seen it pop up on Stephen Colbert, the Drew Barrymore show. It's kind of happening all over the place. National Pickle Day, which of course there is a National Pickle Day, November 14th, we launched a toothpaste with Boca toothpaste. It actually sold out. The increases were just ridiculous. I think we sold like 8,000 tubes of toothpaste. It wasn't dill-based, it was more cucumber-based. But we've done all sorts of stuff. We've done Polaroid cameras. You can see over my shoulder, we have a Polaroid camera. We've done baseball bats. We've done collaborations with Pop-Up Bagels, with Utz potato chips. We're really just trying to get into the conversation, being selective about how we do that, but make sure that people are talking about pickles and, of course, our pickles.
I've just seen, I saw your pickle fridge behind you, and I've just seen the pickle in a fridge video on YouTube.
Pretty good, right?
How important is social media? I mean, how key is that as a marketing channel?
It's huge for us. It's kind of where we started. We've seen about 50% increases annually on the followers that we have on TikTok and Instagram, as well as the impressions have been absolutely enormous. So I think last month we had 10 plus million impressions across all the platforms. So again, we only really market out of home and target advertising in some key cities like Chicago, Boston, LA, Tampa Bay, and Philly. Other than that, it's really word of mouth. It's seeing the product in store, and it's social media. And that social media with these collaborations, it's really just a great way to organically find people talking about our product. We don't spend a lot of time on production or anything like that. Most of our Instagram Reels and our TikTok is all user-generated content that we just continue to push forward.
Yeah, I noticed you have 147,000 followers on TikTok under Grillo's Pickles. Are you actively trying to steer more of the traffic to Instagram and away from TikTok, given the uncertainty with that platform's future?
Yeah, I'm not sure that we can steer anyone. We're just a small pickle company trying to do the right thing. But we do see both growing. There's a lot of redundancies on both sides. At the end of the day, we grew up on Instagram, so I think we'll be fine from that standpoint.
All right, good stuff. Adam, really appreciate your joining us. Adam Kaufman, CEO of Grillo's Pickles.
You see that Rooch found this pickle index on the St. Louis Fed?
Wait, translation. Our producer, Tim Andreacci.
Yes.
Also known as Roosh.
Not just our producer. He produces so many shows here.
Yes, producer of many shows, but he did find an index of Pickles.
Just up and to the right. I mean, just soaring.
It goes like this.
Couple of years especially.
All right, we've got a lot more coming up. Namely, we're going to tell you what you need to know over the next week of trading. This is The Close on Bloomberg. All right, let's look ahead to what else we're watching over the next week. We got to get past the Oscars, of course, on Sunday night. But
wait, who's your pick?
I like
best film.
Oh, best film. I don't know. I don't know half of them, and that's
The Brutalist.
Really? You watched it?
Killed it.
Okay.
Anora was quite good.
Let's look at what's going to move the markets, because I'm not sure that the Oscars will. We've got global manufacturing PMI, some Fed speak, but really on Tuesday, when the tariffs are expected to take effect.
Yeah, I think that is the big one, because we'll know on Tuesday if we get tariffs on Canada and Mexico, our two biggest trading partners. Plus, Bloomberg Invest kicks off on Tuesday. I'm looking forward to that. We'll have Tom Wagner on my show at 9 a.m. on Tuesday morning. And then I'm going to interview Gary Cohn on Wednesday.
Okay, so that's Tuesday and Wednesday. You want to keep an eye on that. We have a rate decision out of the ECB on Thursday and more central bank talk, because Fed Chair Jay Powell will be speaking on Friday.
The central bank that matters.
Along with the jobs report, by the way. That does it for Bloomberg Markets The Close. Have a great weekend, everyone.